Okay, so now let's turn to look at our wealth strategy and strategy fund range. I'm going to start off by looking at Close Brothers. So Close Brothers are cautiously optimistic on equity markets, but however, they are a little bit more cautious, a little bit more nervous on fixed income. And within fixed income, they're keeping an eye on what they feel is a good entry point for yield levels to increase their exposure to this area. Looking at fixed interest overall, they've been reducing exposure over 2016, having around about 31% for their balanced fund in June. They've now reduced that down to 21%. Also, the duration of the funds is around 3 to 4 years, and that's quite short duration, so less sensitive to changes in interest rates. Looking at equities, Close have reduced their exposure to the US and increased their UK exposure, taking the view that there could be higher levels of volatility in the US, and they've invested in the UK as they want to increase the fund's home bias and also to reduce currency risk within the fund. Next, we have UBS. So UBS have posted some strong figures over the month, with their value bias helping to drive return. In the US, UBS feel that there could be a pullback, not necessarily in equities, but potentially more in bonds. Normally, where the US leads, other developed markets follow. However, there is a disconnect currently between the US and Europe. Looking at the US dollar, UBS feel that we're in a late stage of strength, although within their currency fund, the CARS fund, they're overweight currently. Finally, looking at China, they feel it will perform well over the short term, so in the near future, but could struggle later in the year. Okay, so let's move on and look at 7IM. So looking back over 2016, positive 7IM have been the positions in high yield and also private equity. And the sort of more detractive things that detracted from performance were the UK equity positions and also UK corporate debt. So 7IM are positioned for a brightening outlook, but moderate fiscal and monetary stimulation. So they project global growth of anything from 2 to 3% for 2017 and a position towards a stronger US dollar. The key diversifiers within their funds are alternatives, such as their inflation-linked note. In general, the alternatives have performed well, and they've increased their weighting to this area at the expense of bonds, an area that they could feel could sell off, although they are happy holding a small allocation to US Treasuries. Okay, so let's move on to Schroders. So Schroders have posted some good performance figures over the month. Schroders feel that we are seeing a change in how investors view markets. Last 4 to 5 years, investors have been concentrating on lower for longer when it comes to interest rates, which they feel has led to massive imbalances in the market. Looking at the US versus Europe, Schroders see more value in Europe, with corporate profit margins still below their prior peak, but for the US, margins are now at elevated levels. They feel that US is more late cycle and that incremental growth doesn't come without inflation pressures. There have been no new managers introduced this month, but Schroders are currently looking for more value-style orientated managers to add into their funds. Okay, so next let's move on to Allianz. And actually, if we look back over 2016, Allianz really have posted some stellar performance figures. Looking back at the Balance Fund, the majority of this performance has come from global equities, but they've also seen a currency effect which has come from a weaker sterling. Allianz are concerned that the US dollar is looking too strong, and they've adjusted their positioning accordingly. They were overweight the dollar, so they had a large position within US dollars, but this has now been adjusted back to an underweight position. Allianz have taken quite a contrarian view compared to other managers, feeling that equity markets are stretched and nervous that the Trump administration won't deliver. Allianz, however, have the ability to react very quickly to how events may change or how markets may change, and they can add or reduce risk depending on levels of volatility within markets. Looking towards 2017, Allianz do feel that they will use a little bit less of their risk budget compared to 2016. Okay, so let's move on to Threadneedle. And Threadneedle has posted some excellent returns for December. Particularly good though, as actually they've had very low or zero weightings in the sectors within the UK that have performed strongly, such as miners and energy. And that just illustrates just how well their bottom-up stock selection process has worked. You may well have seen retailers have been in the news recently with Next really struggling, posting a profit warning. So this is an equity that Threadneedle don't own. However, they do own Marks and Spencer's, which is in the same sector, and they feel that with Next suffering from cost pressures, Marks and Spencer's could be one of the main beneficiaries. Threadneedle are less positive on fixed interest compared to equities. They've got quite a low duration position, so again, less sensitive to changes within interest rates, and that's of around about 6 years. Threadneedle have also been reducing credit risk within their fixed interest portfolio, reducing exposures to areas such as banks. The fund itself is currently yielding around 4%, and Threadneedle are positive on the sustainability of this level of income. And they feel that currency devaluation from sterling devaluations will carry on through the year, which will help provide and keep those high income levels. Okay, moving on to SEI. Again, looking back over 2016, they posted some excellent returns with their value style balance really working well. There have been no changes to the funds in December, and SEI continue to favour value and momentum as a style. They're potentially looking to add a manager to their global equity building block who will specialise in emerging markets and frontier markets. They're constructive on developed markets in general, feeling that global markets tend to follow each other with the US leading the way for others to follow. Contrary to some of our other managers, SEI do not feel that volatility levels will rise under Donald Trump's leadership. And lastly, we have Goldman Sachs. So both the Goldman Sachs Dynamic and their Income Builder Fund posted solid positive returns over December. Income Builder continues to offer an excellent yield of over 4%, and that's paid monthly to your client. The fund has benefited from quality management and good stock selection. The Dynamic Fund offers diversification and exposure to alternative investments, a useful way to potentially diversify away from more fixed interest-based investment. Okay, so that's everything from me today. Thank you very much for listening, and I'll speak to you next time. Thank you.